Hello everyone, thanks for checking out my video. We had just experienced one of the most chaotic and volatile weeks ever in the history of Wall Street. Stocks were whipsawed throughout the week, caused by the ongoing tariff war. At one point, the S&P 500 slipped into the bear market territory, but shortly after, we saw a face-ripping rally as the index skyrocketed 9.5% in a knee-jerk reaction to Trump's announcement to put a 90-day pause to most of his reciprocal tariffs. That was one of the biggest one-day rise since October 2008 during the heart of the global financial crisis. Amid the tariff storm, it's unclear how long this latest upswing will last, especially when the market has proven to be so sensitive to the uncertainty around Trump's policies. Alright, we have lots of things to unpack in this video, so let's not waste further time and dive straight into the details. As always, stay throughout the video so that you don't miss a single thing. Okay, so President Trump's fast-moving and ever-changing tariff policy has whiplashed the stock market last week with historic gains during Wednesday's session, but sharp losses on Thursday, followed by an end-of-the-week rally. In the end, the S&P 500 had its best week since 2023, while the Nasdaq's 7% weekly gain was its best since 2022. We also saw every single one of the Magnificent 7 stocks popping more than 10% in the last 5 days. Here's a quick breakdown of what exactly happened last week. It basically all started from last Monday when the S&P 500 opened the day in the bear market territory. This was after S&P 500 clocking one of its worst two-day decline in history. Then came Wednesday. President Trump announced a surprising tariff reversal by putting a 90-day pause on most of his reciprocal tariffs. This sparked one of the biggest and jaw-dropping stock market rally in history, where we saw the S&P 500 skyrocketing a whopping 9.5%. This single-day gain is the third biggest one since World War II. Apart from S&P 500, the tech-heavy Nasdaq also surged as it gained 12%, clinching its largest one-day jump since January 2001, and it is the second best day ever on record. The market basically acted like a coiled spring after a brutal 3 to 4 day stretch of losses that briefly pushed the S&P 500 into bear market territory. In case you weren't aware, prior to the face-ripping rally, the S&P 500 suffered a 12% loss in just 4 days, which is a decline not seen since the pandemic era. Okay, all these tariff plans and the crazy and monstrous market swings aside, we actually had some positive news last week. The latest inflation data in terms of CPI and PPI came in much cooler than expected. This could give the Federal Reserve more leeway to cut interest rates, which generally speaking will be good for businesses and the economy. In addition, Boston Federal Reserve President Susan Collins also gave investors some vote of confidence by saying that the Fed is prepared to keep financial markets functioning should the need arise. But that said, the University of Michigan survey indicates that the US consumers expect inflation to hit 6.7% in the year ahead. This is the highest projection since 1981. Such expectations can fuel a feedback loop that drives inflation even higher. Not just that, last week's inflation reports are backward-looking, which measured the previous month's price levels. The worry is that inflation will rise in coming months as Trump's tariffs make their way through the economy, and that could make the Fed's hands tight. Okay, moving over to the market outlook. Well, without me saying, I would think everyone expects the wild swings in the US and global markets to continue in the coming week. To add fuel to the fire, a weakening US dollar and a sell-off in treasuries have added more volatility and complications to the stock market. I will cover this topic in the End Thoughts segment. Meanwhile, the new earnings season is starting to ramp up again in the week ahead, with a number of major companies due to report. Notable ones are Goldman Sachs, TSMC, ASML, LVMH, and Netflix. As the US President Trump's tariff policies continue to evolve and shake the stock market, investors are eager to hear how major companies view the potential impact of a trade war on the economy in the year ahead. Moving over to the technical analysis section, wow, where do I even begin? Just look at these candlesticks on SPY's chart. The size of the bodies and the length of the wicks say it all. This is a clear sign that we are in a period of extreme volatility with massive intraday swings becoming the norm. At the moment, it looks like the market is trying to recover during this 90-day pause on most of the reciprocal tariffs. So, if the rebound continues this week, the big question is, how far can it go? There are two key levels to keep an eye on. First up, it's the gap area between 548 and 554. If there are no unexpected negative headlines from Trump, the bulls should have enough momentum to push SPY back up into this zone. Next, watch for the 61.8 Fibonacci level at 562. This is a critical level, and it is also one huge level of resistance. As you can see, SPY got rejected at this level twice in the past, and after breaking above it, the same level acted as a strong support on two separate occasions. So for the bulls to reclaim some control, SPY needs to close above 562 and hold that level for at least a week. To be frank, I would say it's quite difficult for SPY to break above both levels if we don't have certainty from Trump's tariff policies, which means I would expect sellers to step in at either the gap area or at 562, but of course I could be wrong. Last of all, just a heads up, keep an eye on the potential death cross forming. I have explained the concept in my recent past videos, and we have seen how it play out on charts like Nvidia and Apple, and we all know what happened when those death crosses appeared. The key difference this time is that we are talking about the broader market, not just individual stocks. If the death cross materializes this or next week, it's a strong signal to stay cautious, especially if you're considering going long or taking on bullish positions in this rally. Actually, I would be surprised if you're not already leaning on the cautious side by now. Before I forgot, if you could recall, my last video talked about this bear flag pattern, and I explicitly mentioned that we could see SPY falling to 480's range in the full bear flag breakdown, and we really saw that SPY hit 481. I hope that could earn a like button from you. Moving over to Apple, well, since we were just talking about death cross, let's cover that first. So in my last video, I specifically mentioned that if a death cross happens on Apple's chart, we could see Apple in the 170s and even 160s range. There you have it, Apple went as low as 169 before staging a solid recovery to the current price of 198. So what's next? My take is, if we don't have negative news from Trump, the current rebound, whether is it a real bounce or a dead cat bounce, I believe there is still strength for the share price to go further up to 210 at least. Why 210? Because that's where the 50% Fibonacci retracement level is. That's the very first test for Apple if it wants to reverse the current downtrend. Just a recap, 50% Fibonacci level is typically a level where the main trend takes over. So in this case, the short-term main trend is down, so I would expect some resistance at this level. But if the market wants to fly further, then just like SPY, watch that 61.8 Fibonacci level, which is around 220. By hitting 220 or 221, Apple would have filled that huge gap down. That's when the next move is critical. If this proves to be a dead cat bounce, then institutions could dump shares around this level. Once again, I could be very wrong. What if Trump starts pumping the market like last week? If so, then we should see Apple staying above the 61.8 Fibonacci level for at least a week. Then I might be slightly convinced that the bullish momentum is back. Otherwise, my view is we are currently in a relief rally or dead cat bounce. Okay, let's now move over to Tesla. Among the stocks that I covered in the TA segment, Tesla looks the trickiest as it shows a number of mixed signals. Let's break them down. First up, it's this bear flag pattern. At one point, it seems like it wanted to break down, and the MACD had a bearish cross. But interestingly, the bearish MACD crossover only happened for one day, and it quickly reversed back. Not just that, Tesla tested the recent low of 217 last week, but bounced back up immediately. In fact, it happened on 2 trading days. This seems like the bulls are trying to reverse the bearish bear flag pattern and creating a potential bullish double bottom. But before you get all too excited, when Tesla popped back into this green zone, it got rejected and fell back down. So all this mixed bearish and bullish signals means what? It means one thing. It is in a consolidation phase, waiting for a next big movement. As you can see, Tesla has been trading sideways in this huge range between 210s and around 290. I believe that the next breakout, whether is it towards the upside or downside, it will breach the range. Here's one important thing to note. Sorry, give me a while. If you have found my content useful during these uncertain times and would like to support the channel, you may consider signing up a long bridge brokerage account using my referral link. I do get some referral fees if you do so. Its promotions are on their website, so I won't take up your time by mentioning it here. You can check out the links in the description box below. Okay, back to business. One very important thing to note, which is none other than an incoming death cross. But I also want to highlight, unlike the other death crosses that we saw specifically on Apple and Nvidia, the 200 moving average for Tesla has not curled towards the downside yet. It is still moving in the up direction. So for a real death cross to materialize, the 200 moving average needs to start moving downwards. When that happens, I do think there is a chance for Tesla to break the recent low of 214 and go below 210. That's a 40-point drop from the current level, which is a 16% decline. But of course, with Trump around, anything can happen. Who knows? He might be able to reverse this whole death cross and the bear flag patterns. For confirmation of any bullish signals, we need Tesla to close above the green zone first, which is between 263 and 272. But in a market like this, closing above the green zone is not enough. It needs to punch above 291 at least for us to say that the bulls are gaining some control. Because by going above 291, it could have crossed the pivotal 50% Fibonacci level as well as close above both the 50 and 200 moving averages. Okay, so to summarize, Tesla's chart is leaning bearish, but Trump could change that anytime. So stay nimble in this environment. If you're going bearish on Tesla, do set stop loss. But if the bearish thesis materializes, the profits could be quite decent. Disclaimer, this is not a financial advice. Moving over to Google. Google's chart looks interesting to me because we had a death cross last Tuesday, and on that very day, Google fell 1.4%, just 1.4%. This was followed by a face-ripping rally of 9.7% the next day, as the whole stock market skyrocketed. So what happened to our death cross theory? Well, first of all, nothing is guaranteed in the stock market, which means not all death crosses will play out. But that being said, it's way too early to say that this death cross is just a hoax. Watch how Google moved this week. Pay very special attention to that green zone, which is between 160 and 162. Google has gone near it on a few occasions but could not seem to go above it. Apart from this green zone, there's another level to watch, which is the 50% Fibonacci retracement level at around 174. If Google can somehow close above 174 in the next 2 weeks, then I might be convinced that the death cross is not playing out. On the other hand, anything below 174 or the green zone, I would say the short-term bearish trend is still intact, and be wary of dead cat bounces, which means market makers will bring the share price up to trap retailers before dumping their shares. One last thing, one positive note is that we just had a bullish MACD crossover last week. So in the very near term, say 1 to 3 days, Google could go sideways or have a small bounce. Unless of course Trump comes out to spook the market with negative news again. Otherwise, I would expect Google to test the green support zone this week. Okay, in case I'm not clear enough, despite the bullish cross on MACD, I remain pretty reserved and skeptical if there is any bounce in Google's share price, unless it reclaims the two resistance areas that I mentioned earlier. Moving over to Meta. Okay, watch this section closely. In my personal opinion, Meta is kind of showing what could happen to those stocks that I cover. What do I mean? Look at how Meta went above the first green support zone, followed by testing the 200 moving average. And more importantly, it got rejected by the 200 moving average. This is a sign of a potential dead cat bounce, which means when the stock is very oversold, there will be an oversold rebound, which brings the share price to key resistance levels before big institutions start offloading their shares again. So in this case, the key levels for Meta will be the two green boxes and the 200 moving average. As mentioned, Meta got rejected by the moving average and it is now floating at the first green zone. If Meta starts closing below this green zone, is very bearish, and I would say there is a high probability that the recent low of 482 could be broken. This time round, we could hit 460s or 450s range. On the other hand, if the relief rally continues this week, once again watch that 200 moving average as a level of resistance. Let's say Trump announces some good news to pump the market, the next level to clear would be the second green zone, which I might drag it to the pivotal 50% Fibonacci level at around 611. Alright, if somehow and somewhat Meta can close above 611 for more than a week, then we can potentially look for a possible reversal in this short-term downtrend. Okay, moving over to Microsoft. Wow, Microsoft actually went near the 50% Fibonacci level last week, but it could not even touch it, let alone closing above it. If the relief rally continues this week, then we can expect Microsoft to finally test this level at around 396. And if Microsoft can close above this level with a few green candles, that's a positive sign. From there, we have one more big level to clear, which is the critical 61.8 Fibonacci level at around 408. And if for whichever reason Microsoft can reclaim this level convincingly as well, I think there is a very high probability that we will hit 417 at least, where the 200 moving average is. In fact, above that 61.8 Fibonacci level, I would expect the momentum to bring Microsoft to touch the gap area between 422 and 439. But at this moment, I don't think Microsoft can fill the gap entirely. On the other hand, in terms of the bearish thesis, very simple, watch those levels that I have just mentioned, which are 396 and 408. And maybe you can throw in 417 as well, which is the 200 moving average. If the tariff uncertainty continues to cloud the entire market, I would expect rejection at either of these levels. And before you knew it, we could be in the 360s range again. Okay, let's now have a look at Nvidia. Well, Nvidia went as high as where the 50% Fibonacci level is, and guess what? It got rejected. Once again, if last Friday's rally going to continue into this week, we can expect Nvidia to test this level again at around 115. A break above this level is a short-term good sign. Furthermore, we just had a bullish MACD crossover. So by going above 115, I would expect Nvidia to enter the 120s range before sellers start to step in again. In the 120s range, pay very special attention to two levels, 121 and 126. That's where the critical 61.8 Fibonacci level and the 200 moving average are. If we can have solid green candles above these two levels, Nvidia could be liberated from this bearish trend. We could easily see Nvidia in the 130s range again. Okay, but on the other hand, if sellers start to step in at either of those levels that I mentioned, then the trend is still bearish, as simple as that. Any rejection could bring Nvidia back to low 100s range. That's when you want to watch that red downtrend channel. As you can see, Nvidia fell into the channel recently but quickly bounced back up. So the bulls would not want to see Nvidia going back into the channel, because it means we could be back in the 80s range again. Moving over to the options trading section, I have 4 trades to update this week. As always, here's a summary page. Okay, the first 2 trades to update are this cash secure put options on Nvidia with strike prices of 195. Both contracts were supposed to expire on 11 April Friday, but I decided to close the 2 positions one day earlier. So what happened was, on Thursday 10 April, Nvidia was falling like crazy. At one point, the share price fell as much as 9% and it went as low as $99, which means it has breached the contract that has a $100 strike price, and both contracts were in the red during intraday. Just to add, the day before, which was Wednesday 9 April, Nvidia jumped close to 19% and both positions were very green. What I'm trying to say is that there were just too much volatility and huge swings for those 2 days, and I really don't know how will the share price move on the expiration day, which is 11 April. Therefore, I make the decision to take the risk off the table and of course to also take profits off the table by closing both positions. I basically paid $50 and $15 to buy back both contracts, and the calculations for these two trades are summarized in this page. The total profit for both trades is about $340 US. Okay, despite the extreme volatility, I still opened 2 new trades last week. The first new trade is this cash secure put on Apple with 130 strike price. The contract was sold on 7 April Monday and will expire on 16 May. 7 April was the day after the stock market saw one of the biggest 2-day decline. Just when we thought the market was going to rebound, guess what? On that day, the S&P 500 opened in the bear market territory as the market continued to fall, including Apple. So in that 3 days, Apple has fallen about 20% and lost more than $600 billion of market cap. That's actually a crash in the share price. The reason behind this big decline is because Apple is one of the most exposed companies to a trade war as it relies heavily on global supply chains and China. Alright, so with this scary huge decline in the share price, why did I still sell a cash secure put, which is a slightly bullish move? Am I crazy? Oh well, hear me out. The reason for opening this trade is because I have never seen Apple being sold off so aggressively before. As always, I think it was an overreaction by the market, and I was of the view that an oversold rebound will likely come. Just to add, I have also not seen the implied volatility of Apple's option contract to be this high before. It's a whopping 77%. To put things into perspective, its IV has always been in the 20 to 30+% range. And in case you're not aware, high IV benefits option sellers like me. Anyway, even if Apple's share price doesn't rebound and it continues to fall, to be honest, I don't mind getting 100 shares of Apple at 130 strike price. Just so you know, the last time when Apple closed below 130 was in January 2023. The company has grown its revenue by so much these 2 years. Therefore, to get Apple shares at a price where it was 2 years ago, I really don't mind. Meanwhile, as Apple popped 4% last Friday, the trade is now sitting on a paper gain of 58%. Okay, the last trade to update is this new cash secure put I sold on Nvidia with a strike price of $83. The contract was opened on 11 April last Friday and it will expire on 23rd May. There were a couple of simple reasons behind this trade. First, I wanted to maintain a steady stream of monthly options income, so I was actively looking for a good opportunity. Second, Nvidia had bounced off that downtrend channel and had a bullish MACD crossover recently. This suggests a potential relief rally or at least some sideways consolidation. That said, I do want to add a caveat. We are in this Trump era where the market is extremely volatile, especially with all the tariff-related news flying all around. Things can change very quickly, so if the market decides to dump, Nvidia's share price could definitely fall further. Just like Apple, even if that happens, it's fine because I chose a strike price that I am comfortable with. In my last video, I shared that I stepped in to buy the Nvidia dip, picking up shares in the 90s range. So if I do get assigned with 100 shares of Nvidia at 83, I wouldn't mind, man. By the way, I almost caught the top when selling this contract. The premium that I received was $2.03, and the highest for the day was $2.05. Anyway, the trade is now up by about 14%. Okay, moving over to the end thoughts section. Apologies in advance, it's going to be a bit lengthy again this week. There are just so many moving parts to cover. Alright, so the stock market remains clearly unsettled as investors struggle to price in a potential economic fallout from President Trump's ever-evolving tariff plans and possibly a permanent shift in the global trade landscape. Even with the 90-day pause on most of the reciprocal tariffs, most investors know we are not out of the woods yet. trade negotiations are still ongoing and it's too early to signal an all clear. And the reality is we really don't know what kind of headlines might drop next, positive or negative, as each country positions itself to extract the maximum amount of concessions. The market is trapped in this cloud of uncertainty. Zooming out, the bigger picture suggests that the global trade order is set to be reshaped by President Trump, and the escalating tensions between the US and China, which are the two largest economies, could cause widespread damage and a possible global recession. And beyond the stock market, there are broader concerns. This ongoing trade war is eroding consumer confidence in the US, which may lead to weaker spending and eventually hurt the economy. But it's not just about trade. Wall Street is also keeping a close eye on other warning signs. The US dollar index has slipped to a 3-year low, treasury yields have climbed, and consumer expectations for inflation rose to its highest level in 4 decades. Okay, I just want to spend a bit of time to talk about the treasury bond yields because this part is very important. Some say that the recent spike in yields has spooked President Trump into announcing that 90-day pause in tariffs. What happened was, last week, the 10-year Treasury yield jumped to 4.5% and the 30-year hit around 5%. That's very alarming, especially since Treasuries are considered one of the safest financial assets. Here's the issue. Historically, in times of global uncertainty, treasuries usually attract investors looking for safety. But now we are seeing a breakdown in that dynamic. Confidence in the US dollar and treasuries as safe havens is starting to weaken, and that suggests something more fundamental might be shifting. So why does this matter? Because treasury yields are closely linked to interest rates on things like mortgages and car loans. When yields go up, borrowing costs rise. That could lead to a contractionary environment, which means fewer home buyers, fewer big-ticket purchases by consumers, and less capital flowing into investments. All of this signals a slowing economy and possibly stress in the broader financial system. Furthermore, higher yields also make bonds more attractive compared to stocks. This means risk assets like equities will likely continue to struggle unless yields stabilize. And keep this in mind, rising yields often reflect inflation expectations. Bloomberg even noted that this is the largest surge in yields since the 1980s, when inflation peaked at 14%. So when you see bond yields surging, the dollar weakening, and the stock market swinging wildly, it's all pointing to a serious economic instability. Okay, now you might ask, why this unusual scene? A few reasons. Investors outside the US could be selling US bonds in response to trade tensions. Hedge funds might be offloading assets to raise cash. More concerning issue would be the growing doubts about the US as the world's safest place to park capital, largely because of Trump's unpredictable tariff policies. And I guess all these factors have raised enough red flags to grab the attention of both Wall Street and the White House last week. Okay, if you have found this breakdown useful, don't forget to hit the like button, it really helps to support the channel. With all that said, I want to reiterate that all these are short-term concerns, at least for now. I personally believe things will stabilize in the next 1 year, or worst case scenario once current Trump administration ends. Therefore, if one's time horizon goes beyond Trump's term, this could be an opportunity to pick up shares of great companies at a discount. As I have mentioned last week, buying during moments of extreme fear and historic sell-offs often leads to solid long-term gains. Take Nvidia for example. I said I would step in if it fell below $100, and I did when it dipped into the 90s range. Those shares are already up 20% in just 1 week. Alright, I'm not saying we are out of the woods, and I know Nvidia could easily dip back into the 90s or even the 80s range again in the short term. My point is, last week's rally showed how dip buying during drawdowns can pay off when markets stabilize. Let's also not forget, this whole situation is self-inflicted. Remember 2020 when it felt like the world was ending during the pandemic, but the world recovered, the US recovered, and the stock market recovered. Last week's rally is a glimpse of how quickly sentiment can turn, even from the same person who triggered the sell-off in the first place. In summary, I do believe that once Trump gets what he wants and tensions ease, the markets will rebound. It may take a year, 3 years or 5 years, but eventually clarity will return. And in the case of a self-inflicted quote-unquote crisis like this, recovery might come sooner than most expect. Alright, that's it for this video. If you found it helpful during these uncertain times, do tap the like button and share it with others who might benefit. Thanks for watching, and I will see you in the next video.